Today's interest rate cut will benefit homeowners, but for those who prefer to invest their money in banks, it could mean less in their pockets. To explain how those across the board will be impacted, David Andrew of Capital Partners and the West Australian's Group Business Editor, Ben Harvey, joined us earlier today. Thanks to you both for joining us in the studio. Ben, homeowners or home buyers, I guess, would be happy with today's rate cut, but how will it impact on those who have their nest egg in the bank?
Monica, this has been an absolutely disastrous decision if you are someone that does not have a mortgage holder and are in retirement.
Why?
Many retirees have put that nest egg that they've worked so hard for into a term deposit. The problem when interest rates come down is their term deposit rates come down. According to the ratings agency Canstar, those people are now getting just 2.84% on their money. That means if you've got $1 million in your term deposit, you're surviving on just $28,400 a year in interest. This compares with more than $33,000 a year if you're on the old age pension.
Could this stop people saving, putting their money in a bank? I mean, what is the point of saving for a rainy day?
Well, I think it's tough because for those people on fixed incomes, all of a sudden they're looking for higher returns. So it's quite common for people to be seeking out higher risk investments, and that's something that we think they need to be really careful of.
Where should people be investing their savings then for a greater return?
Well, the important thing with investment is diversification. Look for blue chip assets that might be giving you a 4 to 5% return in dividends. Look for things like corporate bonds that are safer than some shares. Look for things like annuities. Just make sure you've got a good spread in whatever investments you have.
Where do you see rates heading? Can they get much lower, do you think?
Well, I think the Reserve Bank is in a really difficult position because the property market in Sydney is running hot while the rest of the economy is really sluggish. So I think we can probably expect another rate cut and then things will level out from there. I think it's important for people to remember that rates will go up again sometime, and we think the smartest thing that they could possibly do is make that extra $45 a month payment into their mortgage, and in some cases they'll probably pay their mortgage off at least a year earlier.
Do we stay variable or fix?
I think if people are stretched and then they know that as interest rates go up and they're going to struggle to meet their repayments, now might be a really good time to think about fixing their mortgage.
Perhaps some confusing times ahead for investors. Gentlemen, we'll have to leave it there for now. Thank you to both of you for coming in.
You're welcome.